Hello guys, in this video I'll be teaching you how to choose the specific currency pairs that you're going to trade in the Forex market. So looking at the market watch list, we realize we have hundreds of trading pairs. The currency pairs are a lot, so it's so difficult to be able to navigate and trade each of these pairs every day, every week in the market. So how do you know which currency pairs to trade in the best way possible? Can you trade all of these currency pairs? Typically the answer is yes, because it's not illegal. I mean, if you are to decide to trade every of these pair and analyze each of these ones, you can be able to trade all of them, I believe, in the trading platform. Do you need to trade all these pairs, or should you trade every currency pair for you to become successful? The answer is no. If anything, most successful traders have mastered the art of trading very specific instruments in the market. So some of the top traders that I know only trade 1 to 3 currency pairs at a time or instruments. So it does not mean that you have to trade the exact number, but it's a clear indication that profitability in the forex market is not directly proportional to the number of pairs or instruments that you trade. So having many pairs will not mean you'll become more profitable and vice versa. If you are thinking of trading all of these markets, I would not recommend, because it is not sustainable in the long run. Different markets are very dynamic, so different pairs have unique characteristics and they don't necessarily behave in the same way. And this is in terms of the price action behavior. How price moves is very different across each currency pair, and also the volatility. Some pairs will be more volatile, some will be less volatile. If anything, you realize trying to master how each pair behaves at the same time, or trying to be a master of each currency pair, will just be frustrating to you, and it will conflict you because you are trying to understand the characteristics of all these pairs at the same time while there are very, very many. So if anything, you are likely to get stagnated instead of finding any progress. Also, you are likely to make a lot of mistakes when you try to master all the pairs at the same time. Whereas if you focus on specific pairs, you realize it's easier for you to understand them in and out and be able to trade them, analyze them profitably. If you look at all the pairs at the same time, you're very likely to make a mistake. You're likely to forget something in your analysis, and you're likely to get confused. So focusing on a few pairs still beats trying to trade everything at the same time. And now the big question becomes, if you're not supposed to trade every pair in the market, so what specific pair should you trade, and how exactly do you determine the exact pairs that are better off trading as compared to others? The answer is simple: backtesting. So once you have a working strategy that you have clearly defined, that you understand the criteria that you use to get into the market, depending on your trading style or your trading approach that you prefer, you want to run that trading criteria or trading style through different markets using the past data. So you want to be able to backtest different currency pairs, in short, or different trading instruments using your style of trading, and the aim is to gauge the performance in the past. With backtesting, I always advise do a minimum of 100 setups. Minimum of 100 setups. The more the better, because the more the data, the more proof you have, and the more reliable the results. Since you've already determined that different markets don't have similar characteristics, it is very false to assume or imagine that one trading strategy will perform very well across all markets, or imagine that a good strategy will have the same performance across all markets. This is a mistake that most traders make. You find a strategy that is performing well on one currency pair, then you assume if you just apply it across all markets, you are going to have the same performance. That's a very wrong assumption. And the opposite is true. Traders find a strategy that they consider bad or is not performing well, but they've only tested it on a specific trading instrument or currency pair. Then they generalize that the strategy has poor performance. You could be shocked that it's performing poorly on the specific pair that you are trading, but if you try to backtest on different pairs, you realize that it actually works better with others. Now, how do you backtest effectively? It's very possible to do the backtest and still miss out on very important factors. So I'll give you tips to ensure that your backtest is highly effective, and this will eventually enable you to select the best performing currency pairs. So under the tips, when you are backtesting, one thing you want to look out for is number one, the success rate. When I talk of the success rate, I simply mean based on your criteria for validating a good trade, with your strategy. The criteria that tells you when I see maybe 1, 2, 3, and 4, I know this is a good trade or a setup. Based on that criteria, when you run it through the markets, you want to be able to see which pairs are respecting the criteria most of the time. So you realize, maybe assuming you trade on specific zones in the market, try to mark the zones in the market, then you want to go in the past data to see on those zones which pairs are likely to respect the zones as compared to others. So the pairs that respect the zones most of the time, that is an example, you want to take note of these pairs. On the other hand, there are pairs that have low success rate. That means maybe if you trade on specific key levels in the market, you realize across some specific pairs, these levels are never respected, or they are likely to be disrespected most of the time. So you want to eliminate these pairs in your watch list, and you want to focus on the pairs that have a high success rate. Next thing you want to look out for is the risk to reward. Once you've already determined the currency pairs that have a high success rate, I want you to go to those currency pairs and try to look for the ones that offer the best risk to reward. So assuming your stop loss is, let's say, 20 pips, you want your take profit to be at least 2 times your stop loss. So that is, whatever you are risking, your reward is twice minimum. But the higher the risk to reward, the better. Meaning, if your stop loss is 20 pips and you get even 100 pips for profit, that means your risk to reward is 1:5. So the higher the better. I recommend a minimum of 1:2, meaning your profit should always be at least twice whatever you are risking. But the higher the risk to reward, the better the performance. So I just used an example of a stop loss of 20 pips, but this doesn't mean you have to use 20. You'll have to backtest and see the stop loss that is working best again with your currency pairs. If you decide to use a stop loss of, let's say, 30 pips, risk to reward of 1:2 in this case will be 60. So it just continues like that depending on the stop loss that will be working best for your pairs. This is a good example where I'm using a stop loss of 45 pips and the take profit is 135 pips, meaning my risk to reward is 1:3. So my profit is 3 times my stop loss. So if I lose, I'm only losing 45 pips. If I gain, I'm gaining 3 times, meaning one profitable trade can recover 3 losses in case of any. Finally, another tip that you want to look out for in the backtest is the volatility of the different currency pairs. So on these selected pairs, again, you want to analyze and check the ones that have good volatility. And with volatility, we're just talking about the movement of the currency pair. So which currency pair moves quite significantly as compared to the other? So you realize there are pairs which will make some good moves. Whether it is buying or selling, we have some significant moves. Then there are pairs which are just likely to play for a very long time before they can make a move. So they have very low volatility. So the idea of having good volatility or high volatility is very simple. But then also, if you talk of high volatility, you also have to know that the higher the volatility, the more risky sometimes the currency pair. For example, on things like gold or Nasdaq, US 30, they are very, very high volatile. And also statistics show that most traders who lose trade those specific instruments. Anyway, back to my point. As long as you've backtested, the advantage of having a good, currencies that have good volatility is very simple. If you open your trade, it's likely to hit your take profit very, very quickly. Maybe not immediately, but it's likely to go to your profit somewhere soon. Also, if the trade goes against you and hits your stop loss, it will also hit your stop loss in time. So you don't have to hold your trade for a very long time. The disadvantage of low volatility, these are pairs that hardly move. So if the trade opens here, you find for 2-3 days the market is just playing around the same point. So it is hardly going to your stop loss, hardly going to your take profit. So it forces you to hold the trade for a very long time. Eventually it could go to your profit or loss, but I just recommend try to focus on pairs that at least move not so quickly, but the idea is if you backtest, you can see that they eventually go to your target without having to sit in the trade for the longest time possible. This will also be very, very good for your own mental state. because psychology is very important in trading. And once you have a pair that keeps on playing around for a whole, 2 3 days before it goes to profit, if your psychology is not strong enough, it could easily affect you, end up manipulating the trade. So having a strategy that allows you to have your trade close very, very fast is also quite advantageous. Another challenge with volatility is that hitting your target sometimes becomes a nightmare. You have to really be patient and you might even not hit your target. For instance, you see on this currency pair, my take profit is 135 pips. There are currency pairs, if you try to target 135 pips, you will really struggle. So the pair can move 100, 120 pips, it reverses. Meaning if I'm targeting 135, I have to look at pairs that are most likely to give me that 135 pips. People who trade instruments like gold, you see them getting out of a trade with 300, 400 pips. It's possible when you're trading gold, Nasdaq, you're static because they are very volatile. But if you try and now, if I come and try to target 300 pips on my pairs, it I won't be getting those pips very, very often. As you can see, this is an example where I only did 135 pips, hit my target, and it continued going opposite. So if I come and start to focus to hit 300, 400 pips every other time, I'm going to struggle. But someone who's trading gold or a volatility, a currency pair that is highly volatile, is likely to hit more pips, and it might also help you to get a better risk to reward. So you just analyze depending on your trading style and what is working for you, then choose that. So now we are almost getting to the end. Now you've done your back test, you've already determined the best pairs in terms of volatility, in terms of the one that moves well, the best risk to reward, and what else in terms of success rate. So once you've already determined these pairs, let's assume after doing the backtest from 50, hundreds of pairs, whatever the number, you've come up with about 8 to 10 pairs that are all having a significant performance. So now from here, what step do you take? Should you now trade all of these 8 or 10 pairs, or should you again narrow down? So my advice would be simple. Just try to focus on a few pairs. If possible, you can just focus on one pair that performs very, very well, as long as it gives you 3 to 5 setups in a month and you have a good risk to reward of 1 to 3, for example, you are good to go. Because if you have 1 to 3, meaning one trade, if you risk 1%, could give you 3%. If you get 5 setups in a month, only 5, and maybe you lose 2, you win 3, you'll still close your month with close to 10%. That's very, very good performance. So if you have one setup that can prove to you from your backtest, it can give you 3 to 5 setups in a month consistently and has a good risk to reward, you could just decide to focus on one. That is one scenario. The other scenario, which I think most traders take, including myself, is that you could decide to narrow down to maybe 2 to 3 pairs. For my case, I have 5, but let's assume you have just 2 to 3 pairs that you want to trade. But in this case, there are also some specifics that you have to know. Otherwise, you might still make a mistake. In the case that you decide to choose, let's say, multiple pairs, so all of them are performing well, all of them have a good success rate. In this case, you want to make sure you avoid something called correlation. So you want to avoid pairs that do correlate. Pairs that have correlation simply means that these pairs are likely to move the same 70 to 80% of the time. Also, these pairs are usually affected by the same, they're affected by different market conditions in the same way. I'll show you a very good example. An example of major currency pairs: Euro USD, GBP USD, NZD USD, anything XXX USD, all of those pairs, measures, they all have the dollar. So they are all affected by the US dollar. So such pairs, specifically, if you look at GBP USD, very quick analysis. From the last week, if you check, GBP USD was dropping. Look at Euro USD, last week it was dropping. Look at NZD USD, I'm very sure again it started from the high, it dropped a little bit. So they are not an exact copy paste, but they have a high degree of similarity. And in an extreme case, for example, when we have news or any fundamental factor that comes out which affects the US dollar, for example, if the news of the dollar comes out positive, be rest assured Euro USD will drop, AUD USD will drop, anything that starts with, that has USD as the quote currency, all of them will react in the same way. So this is what I'm talking about when I say correlation. So if you are choosing, let's say, 2 to 3 pairs, you want to be very specific and avoid pairs that correlate. And this is the reason. All of these pairs are moving the same 80% of the time, for example. That means anytime you take a trade here, you are likely to also get a trade on the other and the other. So we have Euro USD, GBP USD, NZD USD, AUD USD. Is there any other that I've left? I think we have 4 of them, yeah? So for example, if you get a setup on one of them, you are likely to get a setup on the rest at the same time. It's very risky to have such a strategy that allows you to be getting the same entries at the same time across the same pairs which behave the same, because this simply means one thing: in the case that the pairs go to your side, of course you'll make profit, but in the case the markets react in an opposite way according to what you're analyzing, it means if you're wrong on one, you're also wrong on the rest most of the time. Okay, so when pairs correlate, I don't always advise for you to keep on focusing on the same pairs that correlate, because if you have pairs that are all behaving in the same way, why don't you just choose one of them and focus on the one that moves in the best way out of all the so for example, in this case we have Euro USD, GBP USD, etc. You could just decide out of all of these, I'll only focus on GBP USD, for example, that alone, instead of looking at each one of them, because if you take a trade on one, basically you're also taking a trade on the rest, and the risk becomes too much, so it is not advisable. It's very good to diversify your risk in trading. So in this case, what I'd advise you to do is maybe focus on one pair, let's say one major currency pair. Try to look for a cross currency and probably an exotic, or if possible, you don't have to force yourself to trade the exotics. You could maybe focus on one major currency pair and also take maybe one metal or commodity like oil, for example, gold, an index like Nasdaq or US 30, if they are part of the instruments that are performing well with your strategy. So that helps you to diversify, because at least these are now moving differently and they're not so dependent on each other. So it helps you to diversify and you won't be getting your setups at the same exact time. So if I can show you my pairs, I trade only these 5. Of course, DXY is not a tradable instrument. DXY is just to measure the strength of the dollar. So ignore DXY. So I trade the rest, which are only 5 currency pairs. The reason why I trade 5 pairs, if I can try to assist you to understand, is very simple. With my strategy, I don't get setups every day. So I'll show you a very good example, like on Euro Australian dollar. My last high probability setup on Euro Australian dollar, which performed well, was on 26th of April. So currently we are at 21st of May. It is close to a month since I had the last good setup on Euro AUD. So if I'm just to sit down and be waiting for a setup on one pair alone, you see, for my case, it might not really favor me. I don't want to be waiting for a whole month or two just to get a setup. That's why I've combined other pairs. So after backtesting, I was able to select these other 4 pairs to make sure if I don't get a setup on one, I get a setup on the rest. And a very good example is Euro New Zealand dollar. If you look at Euro New Zealand dollar, now it's the opposite. In the last 1 month alone, you see, we had a very good setup there, which did about 1 to 3 risk to reward quite comfortably. Another setup just the following week, and another setup again the following week. So we were having a setup each week, 1, 2, 3. Then this currently as we speak, I have a setup that I've just taken during this weekend. It was on Friday, so I'll be holding it to next week. Whether it performs well or not is not a problem, because the risk to reward already here, we've already gained a lot on the previous trades. But the whole idea is some pairs won't be giving me setups all the time. Like Euro AUD has only had one setup in the past 1 month, the most viable setup, because I try to focus on the best, or rather the high probability setups, the ones that are respecting my criteria to the core. While on the other hand, Euro NZD has already given us about 4 setups, of which 3 have already been successful, so we are waiting for the 4th to see how it will behave. Also on a pair like Euro CAD, I took a stop loss this week, but on the other hand, I already had 2 setups just somewhere within the past 1 month. each one of them again doing comfortably a risk reward of 1:3. So this is how I'm approaching my style of trading. Also had another setup here, but this is I think quite over a month. So the whole idea is I've chosen these 5 pairs because there are seasons where some pairs will just take too long to give me a setup. Good example again, GBP The last viable setup I had on GBP is quite long ago. It was somewhere at this zone, and I never got the setup because it happened at midnight. So I can't even count it as a setup. So that's how long sometimes it will take me to get a viable trade. Like in the past 2-3 weeks, I've just been watching nothing. The whole of this week there's been nothing because I'm only taking trades at these zones. And as you can see, the market has entered into this zone in the past about 1 or 2 weeks. So I haven't been having any setup on CBPUD. So if I only decide to focus on CBPUD, you see, for me, I'm going to really struggle. That's why I've ended up selecting all these pairs that are each performing very well according to my strategy. So I just follow to see the one that gives me a setup is the one that I take. And also, you see, I've diversified. You see, this is Euro, Australian dollar, but we have the pound, we have Canadian dollar, we have the pound, we have Canadian dollar, we have New Zealand dollar. So we have variety of um, currencies here. So meaning, if we have news on maybe New Zealand dollar, at least I still have other currency pairs to trade. Unlike the other example that I gave you where all of your currency pairs are correlating, meaning if you have news on US dollar, like on Euro USD, when you have news on US dollar, if you have a trade on GBP USD and ZUSD, all of them are affected, which is a very, very bad approach. But in this case, my pairs have been diversified, so it is quite difficult to get a setup at the same time across all these pairs. As you can see, some of them haven't given me a setup for even close to a month currently. I think the most number of setups I've had at a time is 3. And that has only happened once. For example, in the past 6 months, it's only happened once. But most of the time, I only get 2 to 3 setups in a week across different pairs, sometimes even just 1 to 2 setups. So it really helps me to avoid over trading, to avoid taking bad setups, and most importantly, to avoid over risking by having 5 trades running at the same time. And once you realize that to become a successful trader, you just need to be able to generate anywhere from 3-5% consistently, as long as you have a big prop firm account. That's the goal. So once you realize that if you can make 3 to 5% in a month consistently, you're a good trader with a big prop firm account. You realize that you don't actually need to be trading 100 pairs. It's useless. It's a waste of time. Why should you trade 100 pairs if you just need to generate 5 to maybe 10%, for example? In fact, the more pairs you trade, the more you complicate your trading and you'll even have negative results. So once you realize that, you just focus on a few and it becomes very, very simple. Just to conclude, it's important to note from what I've taught you guys today that a good pair for one trader it won't necessarily be a good pair for another, because we all trade in a different way. We all don't follow the same strategy. You could be trading with my strategy, but maybe use a small time frame like the 5 minute, and I'm using the 1 hour. That alone will change everything. Maybe I use a stop loss of 45, you use a stop loss of 10 pips because you use a small time frame or you use a high time frame. So the dynamics are so many. So long story short, we don't trade the same ways. So it's very important for you to understand that you might find one trader is very good at trading, let's say it's BJPY on the 1 hour. You go and try to apply it, but you can't exactly trade the same way they're trading because you don't know what they're doing. So don't try to copy someone else. Just find what works for you, backtest. Spend a lot of time backtesting. That's where the answers are. All the questions you have about learning Forex, all the questions you have about, which pair should I trade, all those answers are in the market. You just need to find them to backtest and to be able to determine what is working well for you over the long run. If you never have time to backtest, I've always told you, forget about success in trading. There is no shortcut. Until that, I keep backtesting. So always keep backtesting to improve your system and to find any loopholes and make it as highly performing as possible. That's all for this session. I hope that information helps you to find the best pairs that you're going to be trading.